What if the technical analysis you've spent years learning, like, those classic double bottoms, the trend lines, support and resistance zones, what if all that was actually designed to trap your money?
I mean, it's a harsh reality to face, but yeah, today we are looking at the market totally through the eyes of the predators.
Right, exactly. So you are joining us today for a deep dive where we are taking a massive stack of research. We've got professional trading guides, institutional mechanics reports, broker tutorials from places like ePlanet Brokers, Think Capital, and daily price action.
Yeah, it's a lot of material to get through.
It really is. But our mission here is simple. We want to strip away all that dense, intimidating jargon of smart money concepts. We're going to give you a comprehensive, really step-by-step framework to understand fair value gaps, or FVGs, and market liquidity in the simplest terms possible.
Right, because by the end of this, you'll actually know how to spot the footprints of massive institutional money, and more importantly, how to place safe stop losses and avoid the really expensive mistakes that trip up, well, almost every beginner.
Yeah, those beginner mistakes are brutal. Okay, let's unpack this. To understand how to trade on the same side as those massive institutions, we have to understand what a fair value gap actually looks like on the chart, right?
Exactly. I mean, it requires a fundamental shift in perspective. You have to stop looking at a chart as just, a history of prices.
Right.
And you start looking at it as a map of liquidity. You stop trying to guess where the market might go, and you start waiting for mathematical proof of where the big money has already laid its traps.
Mathematical proof, I like that.
Yeah.
So we are talking about the literal footprints left behind when millions or even billions of dollars enter the market all at once.
Yeah, and to see those footprints, we focus on a very specific three-candle pattern. So picture 3 consecutive candles on your chart.
Okay, I'm picturing it.
So the first candle establishes a starting point. Then the second candle is what we call the displacement. It's this massive momentum candle that just shoots up or plunges down.
Like a huge surge.
Right, a huge surge. Then comes the third candle. Now, in a true fair value gap, that third candle forms, but its wick never stretches back to touch the wick of the first candle.
Oh, I see. So it literally leaves a physical empty space on the chart. Like in an uptrend, it'd be the gap between the high of candle 1 and the low of candle 3.
That's exactly it. That unfilled space is the fair value gap. And honestly, understanding the mechanics behind it is far more important than just memorizing the shape of it.
Because it's about why it happened, not just what it looks like.
Right. A gap forms because institutional money enters the market with such violent aggression that there simply aren't enough counter orders to match them.
Wow.
Yeah, the demand or supply is completely one-sided. It causes a temporary breakdown in the two-sided auction process, so the price literally skips over those intermediate levels entirely.
I mean, I'm trying to visualize the sheer force of that. It's like, imagine a massive freight elevator in a skyscraper, right?
Okay, I'm with you.
Normally it stops at every single floor. Floor 5, buyers and sellers exchange, floor 6, more exchanges. That's normal, healthy price action.
Right, nice and balanced.
Exactly. But suddenly, the elevator's cables snap. It plummets from floor 8 straight down to floor 4. There's zero friction, no brakes, and nobody has time to get on or off at floors 7, 6, or 5. It just leaves this total vacuum in the middle of the building.
That captures the lack of liquidity perfectly. There are no buyers waiting on those middle floors to catch the falling elevator, so it just keeps dropping until it finds them.
It's free falling.
Exactly.
Yeah.
But the market is an incredibly efficient machine, and it hates vacuums. It's constantly seeking equilibrium.
So it wants to go back and fix it.
Yeah, because those middle floors were skipped, that gap acts like a magnetic void. Eventually, the price tends to retrace back into that gap to fill the missing orders, offering a fair price to the participants who were bypassed during that initial massive move.
Which brings up the core engine of this entire mechanism, which the sources talk about a lot: liquidity. They define liquidity simply as the fuel the market needs to move.
That's a perfect word for it, fuel.
And that fuel exists wherever retail traders put their stop losses. But wait, I have to ask to clarify something here. When analysts say the market is, seeking liquidity, Does that mean the market actually wants to hit everyone's stop losses? Because that sounds incredibly malicious.
I know it sounds super personal, but it is purely mechanical. Think about the logistics of a major hedge fund for a second.
Okay.
If they want to buy, say, 100,000 shares of an asset, they can't just click a buy button and get filled instantly at the current price like we do.
Right, because their order is too big.
Exactly. They need an equally massive cluster of sell orders to absorb their purchase. If they don't have that, their own massive order will skyrocket the price before they even finish buying.
Oh, which ruins their average entry price.
Exactly. So they have to find a place where thousands of people are willing to sell all at once.
Okay. And where do thousands of retail traders naturally place sell orders? Right below key support levels in the form of stop losses.
You got it. When a retail trader buys, their stop loss is technically a pending sell order.
Right.
So if an institution can push the price down just enough to trigger that massive cluster of stop losses, a flood of sell orders hits the market. The institution swoops in, absorbs all those panic sells, and gets their massive buy order filled at a deep discount.
Man, that's wild. And that's what we call a liquidity sweep.
That is exactly what a liquidity sweep is.
They're essentially engineering a fake panic just to trigger our protective shields, using our own risk management against us so they can load up their bags. That really changes the way I view every single dip on a chart.
It should. It definitely should.
Which means we can't just blindly trade every empty space or gap we see, right? Because some of those moves are just noise, while others are these intentional sweeps.
That is the crucial distinction to make. Knowing how to differentiate between types of liquidity is what separates a profitable trader from becoming institutional prey.
Institutional prey, wow.
Yeah, and the research highlights a really classic trap here. Equal highs and equal lows. Or EQH and equal.
Oh, I know that one. Like, if I'm reading a standard technical analysis textbook, I see the price drop, hit a specific level, bounce, and then drop to hit that exact same level a second time.
Right, the classic pattern.
Yeah, I'm taught to see a double bottom. I'm thinking, wow, this is a reinforced steel floor. I should buy right here and put my stop loss safely right beneath that solid line.
And by doing that, you are willingly walking right into the trap.
Just handing them my money.
Pretty much. While beginners see equal lows as undeniable strong support, smart money algorithms see them as a dense pool of trapped liquidity.
Because everyone is hiding their stop losses in the exact same spot.
Right, because every retail trader on the planet is putting their stop loss just a few ticks below that double bottom. The institutions know there is massive fuel resting there.
So they go hunt it.
Yeah, they will intentionally engineer a short-term sell-off to push the price just below those equal lows.
They break the floor on purpose.
They break the floor, trigger all the retail stop losses, which floods the market with sell orders, remember, and they instantly buy them all up.
Right.
Once they've absorbed the liquidity, the market violently reverses in the original intended direction.
Leaving all the retail traders stopped out and completely confused.
Exactly. What's fascinating here is that this completely changes the way a trader views a chart. It forces you to stop guessing directions and wait for actual structural proof of intent.
Okay, so this is where that three-layer confirmation model from the sources comes into play, right? It forces you to wait for the institution to show their hand.
Yes, the math doesn't lie here. This model demands structural move before you risk a single dollar.
Okay, lay it out for us.
Layer 1 is exactly what we just discussed, the sweep. A high probability setup basically does not exist unless the market first sweeps a major liquidity pool, like an equal low or an old swing high. That proves the fuel has been harvested.
Okay, so the trap is set, the fuel is harvested, but how do we know they're actually reversing the market and not just, continuing to crash downward?
That's where we look for layer 2, the displacement. Immediately after grabbing liquidity below those equal lows, the price must aggressively reverse and break the local market structure.
And this is where our fair value gap is created.
Exactly. The middle candle of this reversal must be massive. Ideally, we're talking 1.5 to 2 times the size of a normal candle, with about 70% of its range being a solid body.
So it can't just be a timid, wispy little wick.
No, absolutely not. It has to screen institutional intent.
It's the elevator cable snapping in the opposite direction. It moves so fast upward that it skips the middle floors and leaves that FVG.
Perfectly said. Which brings us to the final confirmation, layer 3, the order block. The strongest setups occur when this violent displacement originates directly from an order block.
And an order block is what exactly?
It's typically the last opposing candle before the massive move. Think of it as the anchor point. It's the specific price zone where the institutions injected their capital to engineer that initial fake out.
Okay, so they have money tied up there.
Right, they essentially have open positions trapped there, which makes that specific zone highly reactive when price eventually returns to it.
Got it. So we wait for the sweep to grab the fuel, we wait for the massive displacement that breaks structure and leaves an FVG, and then we track it back to the originating order block.
Exactly. That is a heavy, undeniable footprint.
Okay, let's ground this theory in reality. The sources provided an incredible real-world chart example using Ethereum. But before we break down those numbers, we need to talk about where on the chart this gap actually lives. Because trading a gap in the wrong zone is basically a death sentence.
Yeah, location is everything. It filters out the low probability setups. We apply a concept called premium versus discount. You basically take a Fibonacci measurement tool and draw it from the recent swing low to the swing high of the current price leg.
Okay, so just measuring the size of the move.
Right, and the 50% mark of that move is your equilibrium line.
This is pure logical commerce. I mean, if you are in an uptrend and you want to buy an asset, you only buy in the discount zone, which is anything below that 50% line.
Right, you want a deal.
Yeah. You wouldn't walk into an electronics store and offer to pay 20% above the sticker price for a television. So why would you buy a potential asset in a premium zone?
Exactly.
And if the market is in a downtrend and you want to short, you only sell in the premium zone above the 50% line.
It is fundamental retail logic applied to institutional charts. If a massive bullish fair value gap forms, but it's sitting way up in the premium zone near the top of the price leg, the algorithms will largely ignore it.
Because the risk to reward ratio is terrible.
Exactly. You must demand a discount.
Okay, let's look at that Ethereum example. So we are on the ETH 1 hour chart. The price goes on an absolute tear, surging aggressively from $3,800 up to $4,000.
A massive impulse move.
Right, and it moved with such violence that it left a massive untouched fair value gap between $3,860 and $3,950.
So there we have our displacement, and it left a clear void right in the discount zone of that move.
Okay, so the price peaks around $4,100, and retail traders are likely, FOMO, buying the top, thinking it's going to the moon, but then the momentum stalls.
It always does.
Yeah, it starts to retrace. It slowly drops back down from $4,100, bleeding out those retail traders, until it finally dips into that untouched gap between $3,860 and $3,950.
And what happens next?
The moment it hits that discount void, it consolidates briefly, absorbs the resting orders, and then violently bounces higher, continuing the macro uptrend toward new highs.
Yep. If you were patiently waiting with an order in that specific gap, you rode the institutional wave perfectly. It is just a textbook demonstration of the market returning to rebalance and inefficiency.
It's beautiful when it works out like that.
It really is. The algorithms recognized the skipped levels in the discount zone and drove the price back down to fill their remaining bags before launching the next leg up.
But wait, let me push back on this a little bit. If institutions leave these obvious mathematical footprints on the chart, why doesn't everyone just set limit orders at every FVG and get rich?
That's the golden question.
Yeah, what's the catch? Does the price always come back to fill the gap? Do you just sit there waiting forever?
That is the trap of theoretical trading.
Yeah.
The reality is the market owes you absolutely nothing, and not all gaps fill.
Oh, really?
Yeah.
Yeah.
In a runaway euphoric trend, the price might gap up and never look back. But that doesn't mean you blindly chase the price either. You rely on what we call the unmitigated rule, which is also known as one-time use.
One-time use, meaning what exactly?
Meaning a fair value gap only provides a high probability edge the first time the price returns to it.
Ah, because missing orders get filled, the void is plugged.
Precisely.
Yeah.
Once the price trades back into the gap and balances the books, the institutional interest at that specific level is spent. It is mitigated.
Okay, that makes sense.
So if the market ignores a gap and trends away for days on end, you don't sit there staring at your screen holding a dusty limit order. You cancel it. You let the narrative evolve and you look for the next fresh setup.
All right, so let's say the trap is set. The price is falling back into our fresh, unmitigated gap in a discount zone. But catching a falling knife is terrifying.
It definitely goes against human instincts.
Exactly. How do we actually step in without getting sliced? What is the specific entry strategy here?
Well, you generally have two calculated options for entry. The conservative approach is to enter at the very edge of the gap, like the exact moment the price crosses the boundary of the void.
So as soon as it touches the gap, you're in.
Right. You are highly likely to get your order filled because the market only needs to tap the zone, but your stop loss has to be wider, meaning your risk is slightly higher.
Okay, and what's the aggressive option, the one the algorithms actually use?
The standard institutional approach is targeting the absolute midpoint of the gap. In smart money terminology, this is called consequent encroachment.
Consequent encroachment. That sounds so fancy.
It sounds super complex, but it simply means the 50% mark of the fair value gap.
Just dead center.
Dead center.
Yeah.
Algorithmic trading models are programmed to seek out extreme efficiency. They don't feel FOMO, right? They calculate the exact median of the imbalance, assuming that the 50% level represents the truest fair value of the skipped price action.
Wow. Okay.
Entering at consequent encroachment gives you an exceptional risk-to-reward ratio, though you do have to accept that sometimes the market will only brush the edge of the gap and leave without you.
I'm just picturing an algorithm with a monocle carefully calculating the consequent encroachment.
They're probably not far off.
But the entry is only half the battle, right? Where is our shield? Where do we put the stop loss so we don't blow up our accounts when a trade goes wrong?
Oh, this is so critical. This is where the retail mindset just gets destroyed. A beginner will see the gap and they'll put their stop loss right in the middle of it.
Oh.
Yeah. But the market frequently sends deep aggressive wicks straight through the gap to fully fill the void before reversing. If your stop is inside the gap, you literally become part of the liquidity sweep.
You're just offering yourself up as fuel.
Exactly. A safe stop loss must be placed entirely outside the FVG boundary.
Give me a structural example of that.
Okay, so for maximum safety, you place your stop loss behind the originating order block. You know, that first candle of our 3-candle setup.
Right, the anchor point. Why there?
Because the order block is the structural wall. If the price crashes through the gap, ignores the imbalance, and completely breaks the order block, the entire institutional narrative you were trading is invalidated.
The big money isn't defending that level anymore.
Exactly. You want your stop loss to trigger at that point because the trade idea is officially dead.
You put your shield behind the castle wall, not out in the open battlefield. I love that. And once we are safe behind the wall, we need a target. We aren't just holding until we feel good, right?
Definitely not. You target the next major liquidity pool. If you bought at a discount fair value gap, your take profit target should be the old swing high, where retail short sellers have parked their stop losses.
Feeking out their fuel.
Right. You are aiming for a strict 1-to-2 or 1-to-3 risk to reward ratio. For every dollar you risk behind the order block, you are mathematically structured to make $2 or $3 at the target.
So what does this all mean? It means this entire process is a rigid mathematical structure. You have predefined rules for the entry at consequent encroachment, a structural stop loss safely behind the order block, and an exit at the opposing liquidity pool.
It completely strips the emotion out of the game.
Yeah. You're no longer sweating over a 5-minute chart. You are simply executing a business plan.
It is an elegant system, but human psychology is incredibly fragile. Even with a perfect blueprint, the sources dedicate a significant portion of their guides to the common mistakes that just ruin this setup for beginners.
Oh, I know the feeling. You learn a new pattern, and suddenly you see it everywhere. Like every single space between 2 candles starts looking like a golden opportunity.
That is the most dangerous trap. Trading internal noise.
Internal noise?
Yeah, beginners will zoom into a 3-minute chart, see the price chopping sideways in a tight range, and try to trade every tiny gap that forms.
No.
But if there was no major liquidity sweep beforehand, those gaps are meaningless.
Just random fluctuations.
Right. They aren't institutional footprints. They're just random market static. Institutions ignore internal noise. If there is no sweep and no massive displacement, there is no trade.
It's also about seeing the forest for the trees, right? Like, if I find a beautiful textbook bullish FVG on a 5-minute chart, but the daily chart is in a catastrophic downtrend, I'm basically stepping in front of a freight train to pick up a penny.
Exactly. Trading a microscopic gap against a massive higher time frame trend is statistical suicide.
Well, okay.
And the other major destroyer of structure is economic news. Novice traders try to force gap entries right before major data releases, like, inflation reports or central bank announcements.
Oh, yeah, when the charts go crazy.
Exactly. During those high-impact events, volatility completely overrides technical structure. The algorithms basically go offline, and the market will sweep wildly in both directions, hunting liquidity above and below the current price.
Just blowing past your stop losses before finally picking a direction.
Yep, so the rule is simple. Step aside during the news. Let the dust settle, let the institutions place their new orders, and then look for the fresh gaps they leave behind.
Okay, but what about discipline? How do we keep ourselves from forcing bad setups when the market is slow and we're just bored?
Well, the sources outline a great psychological failsafe known as the 5-7 candle rule.
Oh, what's that?
Once an FVG is formed, you start counting. If the price does not retrace and tap into that gap within 5 to 7 candles, the setup is highly suspect.
Why 5 to 7? What's the logic behind that specific expiration date?
It comes down to institutional order flow. If big money injected massive capital to create that gap, they typically want to mitigate their trap positions relatively quickly so they can deploy that capital elsewhere.
Oh, they don't want their money tied up forever.
Right. If 7 candles pass and they haven't driven the price back to balance the books, the narrative has shifted. They have likely hedged or abandoned those positions entirely. The footprint has gone cold.
So you just cancel the order.
You cancel the order.
That's brilliant because it forces you to stay completely grounded in the present market action, rather than just hoping a trade from yesterday suddenly comes back to life.
And finally, the ultimate rule of survival: risk management.
Of course.
No matter how perfect the liquidity sweep looks, no matter how clean the displacement is, you never risk more than 1 to 2% of your account on a single setup.
Because anything can happen.
Exactly. Any trade can fail. Institutional algorithms get outsmarted by larger macroeconomic events all the time. But if you only risk 1%, a loss is just a tiny business expense. Knowledge is most valuable when understood and applied. You apply it through infinite patience, basically waiting for the market to meet every single one of your strict conditions.
A tiny business expense. I really like that. That reframes a loss from a personal failure into just a data point in a winning system.
That's exactly how you have to look at it.
Well, this has been an incredible deep dive. We have taken the dense, highly guarded world of smart money concepts and translated it into a really clear framework. You can now look at your charts and see the actual narrative,
Yeah, it completely changes the game.
Instead of panicking at the chaos, you are hunting for the liquidity sweep. You are waiting for the massive displacement that leaves a fair value gap. You are demanding a discount entry at consequent encroachment, and you are hiding your stop loss safely behind the order block.
You basically transition from reacting to the market to anticipating the entities that actually engineer the market's movements.
But before we sign off, we want to leave you with a final, slightly chilling thought to ponder.
Oh, this is a good one.
We've just spent this time explaining how to track these institutional footprints, right? But the financial markets are an endless evolutionary arms race. Retail traders are getting smarter. They're utilizing AI and advanced software to spot these exact fair value gaps.
Yeah, the playing field is shifting. As the masses learn to identify smart money concepts, the institutional algorithms are already adapting. They analyze retail behavior in real time.
Right.
So if the smart money knows that millions of traders are now blindly placing buy orders at the 50% mark of every gap, how long until they start engineering fake gaps specifically designed to trap the very traders trying to follow them?
A game of chess where the board is constantly shifting under your feet. Thank you for joining us on this deep dive into the source material. We highly encourage you to go open up a chart right now, switch off all your lagging indicators, strip it down to the raw candles, and see if you can spot where the elevator skipped the floors. Until next time.